More and more governments are issuing green bonds to specifically finance environmental projects. Social bonds are also on the rise in a post-COVID environment, where governments need to invest more in social projects and healthcare systems. This is certainly good news, but we can always do more. Luxembourg has gone one step further by issuing a sustainability bond in order to finance both environmental and social projects. Indeed, meeting the ambitions of the Paris Accord goes hand in hand with achieving the 17 Sustainable Development Goals defined by the United Nations. Luxembourg's sustainability bond will help finance investments like public transportation, affordable housing, schools, and hospitals. Moreover, in order to underline its commitment, Luxembourg has given itself a dedicated sustainability bond framework. This not only defines eligibility criteria for green and social projects, which are already in line with the latest EU recommendations, it also, importantly, requires an environmental or social impact assessment for each project financed through Luxembourg's sustainability bonds. Luxembourg is once again a pioneer in the area of sustainable finance, but others will certainly follow. In addition, by listing this bond on the Luxembourg Green Exchange, LGX, the government commits to fulfill all the listing and reporting requirements this platform has set up to ensure transparency and trust in the sustainable nature of the bond. Sustainable finance, together, let's make it happen.
Welcome to the Sustainable Finance Forum, bringing together key sustainable finance experts from across the world to share their views on how finance can shape a sustainable future.
Good morning, good afternoon, good evening, wherever you are in the world. Once again, a warm welcome to our studio on the second day of the 2020 Sustainable Finance Forum Luxembourg. Up front, a heartfelt apology for the audio issues you had to put up with yesterday. We worked very hard with our team here in the studio to make sure we've eliminated all the technical bugs and gremlins to be sure to deliver a smooth digital experience to you today. So, yesterday, just to pick up a few thoughts of yesterday, we were talking a lot about the momentum for sustainability, as governments around the world are deploying some $12 trillion to help the rebuilding effort from the impact of the pandemic on their economies. There's a clarion call going around which says, let's use the momentum, make sure that this recovery is a sustainable and inclusive and a green one. And you also heard from the former Secretary General of the United Nations, Ban Ki-moon, how indeed sustainable finance is key to reach those goals we agreed upon as a global community, such as the Paris Climate Accord and the Sustainable Development Goals. And we heard how Europe has been and is leading the way in the development of a sustainable finance ecosystem. And that is what our second day of the conference is about. Which further tools in the regulatory pipeline are coming down from the Commission beyond, for example, the green taxonomy? What do investors and asset managers make of it? And should there be something else that we need to take into account to scale up that sustainable investment? For example, global harmonization of standards. Should other countries follow the example of New Zealand, which recently made climate-related reporting mandatory from 2023 onwards using TCFD standards? Quick note again, if you're making comments about the conference or posting anything on LinkedIn or Twitter, please be sure to use the hashtag. Here we have SFFL20 and then the handle also of Luxembourg for Finance at LuxFinance, so we can all see your comments and share them around. Now, a bit more context to what is going on in the markets, because we'll talk a lot about the investment environment today. The growth trajectory and the numbers show us that, if you will, ESG as an investment criteria is not just anymore something that's nice to have, like hugging a tree. Larry Fink, CEO of BlackRock, recently described sustainability as, and I quote, a tectonic shift in the industry for years to come. And then if you look at the data based on research by Optimas, you will see that since 2016, the overall value of assets under management using sustainability or ESG data as a defining criteria has almost doubled from, in 2016, $23 trillion to 2020, about $40 trillion. So that's quite a jump in 4 years. That said, and this is the other side of the medal that also was criticized in our discussion yesterday. A Financial Times study in February concluded that limiting temperature rise to 1.5%, as we agreed upon in the Paris Climate Accord, would render worthless more than 80% of hydrocarbon assets and evaporate some $900 billion from the balance sheets of fossil fuel companies. So this is why the combined effort of both regulators on one hand and the asset management industry on the other hand is so crucial to help aligning those capital flows with our net zero emission targets. And so now I have the pleasure to turn it over to the regulator's perspective and introduce to you Martin Spolz. He's the head of sustainable finance at the European Commission's Directorate General for Financial Services. And he will share with us what's next in the regulatory pipeline of the Commission under the EU's Sustainable Finance Action Plan.
Good morning. My name is Martin Spolz and I head the Department of Sustainable Finance in the European Commission. I'm very honored to speak at this distinguished conference on sustainable finance. I have been asked to tell you a little bit about what is coming next after we have implemented a number of ambitious actions on the existing action plan. But before I do that, let me just sum up where we have got so far, and only then I will move to the next chapter. Since 2018, when the Commission adopted the first action plan on sustainable finance, a lot has been achieved. 3 legislative proposals have been adopted: the taxonomy regulation, the disclosure regulation, and the climate benchmarks regulation, and now they are entering into force gradually and progressively. The Commission has also worked very intensively with the private sector because we believe in a very strong partnership between the public and private sector. And we have developed a number of concrete tools and frameworks that would help the financial sector mobilize their money capital towards sustainable investment. Just to name a few: taxonomy, the technical expert group on sustainable finance that we established in 2018, developed the first blueprint of climate taxonomy. The technical expert group also developed the first blueprint of the European Green Bond Standard, climate benchmarks, and also climate relevant disclosures for corporates. Now we are moving to the next stage and we are thinking what next we need to do in order to keep the ambition high. It is very clear that the action plan on which we have been working over the last 2.5 years is a very good basis, but it is not sufficient in the current context. There are 2 major developments that have really changed the landscape of sustainable finance. The first development is the European Green Deal. The European Green Deal is the first top priority, policy priority of the European Commission. We have made it very clear that the European Commission and the European Union would like to achieve climate neutrality by 2050, and we have also recently increased the target for 2030 for climate and energy targets. It is clear that the ambition with which we have pursued sustainable finance until now must be increased. The second context, which is changing the landscape tremendously as well, is the recovery context. When the crisis started in spring this year, there have been some voices that we should put the sustainability agenda aside and we should wait first for the recovery to happen so that the sustainability agenda can come back again. Well, we believe that these 2 agendas, a recovery context and the speedy recovery and the green transition can reinforce each other. And ultimately, there is no trade-off. We do strongly believe that the recovery package that the European Commission put forward and now is being negotiated can accelerate green transition and all the progress we are trying to do on sustainable finance. And vice versa, sustainable finance can help a lot to accelerate the recovery. We just need to make sure that the recovery is done in a way that is supporting the European Green Deal objectives and not undermine it. In this context, it is clear that we really need to shift the gear to a much higher ambition. And we need to also think very, very hard together with the private stakeholders on what needs to be done next. We launched a comprehensive public consultation on the renewed sustainable finance strategy in April. We received more than 650 responses to our public consultation. We have structured the public consultation into 3 clusters. First, we thought that it's needed to establish a first common basis, a kind of ecosystem for sustainable finance. And there we are still having some gaps, for instance, disclosure requirements for corporates, or how sustainability ratings or credit ratings are working. So this is the first cluster, making sure that the foundations for sustainable finance work as they should. The second cluster is about maximizing the impact and maximizing the opportunities that the private sector, and not only the financial sector, but also businesses have with this agenda. So here we are looking how to mobilize retail investors, how we better align the private and public capital, and many other aspects that we have explored in the consultation. Finally, the third cluster that we are looking at is how to manage risks, and how to manage risks better not only of individual institutions, but how to manage risks of the system overall, how to increase the resilience of the financial sector and businesses overall much better. Now, let me be a little bit more specific and highlight 6 areas where we believe we need to do better in the next strategy. The next strategy is going to be presented by the Commission in coming month, and we are now elaborating on the way forward. I cannot tell you today how this action plan will look like, but let me share with you maybe 6 themes of our deliberations, of our thinking. First, we need to make sure that we are shifting the mindset from greening finance to financing green. We need to make sure that the financial sector is part of the solution and is supporting the businesses and companies on their transition pathways. Of course, we need to make sure that we are still greening the financial sector, but the focus now needs to be more shifted towards making sure that the financial sector, again, supports the businesses on their transition pathways. And here we are not talking only about businesses that are green today already, but in particular about businesses that are not yet green, that are not yet sustainable, and where the financial sector needs to support those businesses on their transition pathways. So here we need to think harder how to accelerate this transition, not only towards sustainable investments, the dark green space, but also how we can accelerate the transition from activities that are currently significantly harming environment to activities that are providing less harm, how to reduce the harm. The second theme and the second topic I would like to share with you is, in the context of the recovery, we need to think harder how we can make the private frameworks for sustainable finance better aligned with the frameworks and tools that the public sector is using. This is very relevant, especially now in the recovery context, where a lot of public money has been poured into the system. And we need to make sure that this money incentivizes the private sector to steer the action in the right direction. We have launched several initiatives in this respect. We are now exploring inside the Commission how, for instance, the EU taxonomy and the European Union green bond standard can be used also by the public sector. The third topic is about making sure that we are comprehensive enough, that we go beyond climate. Our action plan from 2018 has focused and prioritized climate objectives. But we need to make sure that now with the new plan, with the new action plan, we are going beyond climate, and we are also extending our attention to broader environmental objectives and issues, social objectives, and governance issues. This crisis has made it very clear that we need to pay attention to the social issues, and as part of the platform on sustainable finance, we are now exploring whether the taxonomy could be and should be extended to social objectives. When it comes to governance, the European Commission already announced an important initiative on this next year, and you will certainly hear more about the Commission's proposal, how to mainstream sustainability considerations in the way of how corporate governance works. The fourth issue is about promoting long-termism. Promoting long-termism was one of the key recommendations of the high-level expert group from 2018, and we have followed up on that, yet we have not yet had many actions. So with our new action plan, we would like to articulate better how we can translate the big targets, how to achieve climate neutrality by 2050, how to increase the climate and energy ambition before 2030, what it means for the companies, what it means for the financial sector, and what needs to happen on the transition pathways in between. The fifth issue is about resilience. I have already talked about the need to make sure that we don't only look at the risks that individual institutions are facing, but about the risks that the whole systems are facing, and the resilience that the system needs to have. This crisis has made it very clear that our systems, the financial sector and the corporate system, need to work harder on making sure that the resilience is much better. Finally, we need to look beyond Europe. We are very confident that we will reach all these ambitious targets I talked about, but we need to be aware that even if we are successful, and we will address, when it comes to climate, only 10% of global emissions. So we need to look beyond the European Union, and we need to find ways how we can accelerate this positive development, not only in the European Union, but in other countries. And there are positively already some countries who are working very hard on promoting sustainable finance in their jurisdictions. Nevertheless, currently there is not a forum where the jurisdictions would speak with each other and exchange notes who is doing what. So for that reason, a year ago, the European Commission initiated a new action to launch a so-called international platform on sustainable finance, which is gathering all key jurisdictions that are very serious in promoting sustainable finance. This international platform celebrated the first anniversary 10 days ago, and we are very happy to see the progress, not only in terms of mapping who has done what, but on the ambition to converge on some of these frameworks, taxonomy, green bond standard, and disclosure going forward. Now, I would like to say that for the European Commission, for the success of the new strategy, it's very important that we continue this very strong partnership between the public and private sector. We started this project with the high-level expert group on sustainable finance back in 2017. And the recommendations that we received from these experts were really outstanding. For that reason, we have established this technical expert group on sustainable finance that supported the European Commission over the last 2.5 years. Now, we have to make sure that this success is also translated in the way going forward. We have established a new platform on sustainable finance that will now support the European Commission in developing taxonomy going forward. Those of you who are familiar with the work of the European Commission on taxonomy know that before the end of this year, the European Commission will adopt a delegated act on the climate change adaptation and climate change mitigation objectives. Yet there are still 4 environmental objectives on which the delegated act has to be completed, and we will do so next year. But we need to work with experts, we need to work with the private sector, and not only the financial sector, but with corporates and experts, academia, NGOs, who understand the different sectors and the scientific expertise that we need to have. So this platform that we established 2 weeks ago will work over the next 2 years at the very minimum to help the Commission to make sure that the taxonomy is expanded, is developed beyond the 2 climate objectives, but also make sure that taxonomy is workable and usable on the ground. We are very encouraged by the progress achieved on the ground, but we need to make sure that taxonomy is really being seen by stakeholders as a positive tool that is making a positive contribution and is useful rather than a regulatory burden. Now, what you can expect from the Commission in the beginning of next year. There will be a big legislative proposal that will also be another game changer on sustainable finance, and that is the review of the non-financial reporting directive. So far, we had a gap between the disclosure and transparency by the financial sector, on which we had already legislated, and the disclosure and transparency provided by the corporates. We already have a legal framework in the European Union, the so-called non-financial reporting directive. We also have the guidelines supporting this directive, but it's clear that this directive is not fit for purpose in the current context. So the European Commission announced that we will table a legislative proposal that will not only integrate the work of the TCFD that has been already agreed at a global level, at least at the FSB and G20, but we will go even a step further, and we will not consider only the impact of climate change risks on the companies, but also the impact of companies' activities on climate and on other environmental objectives. So we have a very ambitious agenda ahead. I would like to thank all of you who have contributed to the public consultation on the renewed sustainable finance strategy. On top of the strategy on sustainable finance, we are of course working also on the European Union Green Bond Standard. You have seen that there was another dedicated consultation. And you have also seen that President of the European Commission announced in her speech in September that the European Commission itself will issue green bonds in order to support and accelerate green transition. So as you see, there is a lot of good momentum. We are very grateful for all the great initiatives that you are taking, you are making. And of course, Luxembourg is one of the key stakeholders and frontrunners in this field. Thank you very much for giving me the opportunity to speak to you today, and we will be very happy to stay in touch. Thank you. Have a very nice conference.
Thank you, Martin Spolz, head of the Sustainable Finance Unit at the European Commission's Directorate General for Financial Services. So I think there was a lot in there that will go down well with asset managers and investors alike, and we'll discuss all that over the course of the next hour or so. And we want to switch, though, the perspective now from the regulator to the private sector. And to that effect, I have the great pleasure to welcome here in the studio and introduce to you Christian Stalpe, Managing Director Europe of Fidelity International. For those of you who don't know Fidelity, they're one of the largest asset managers on the planet with some $3.3 trillion of assets under management. And Christian, I know that you're in charge of the wants and needs of clients, wholesale clients and institutional investors across continental Europe. So you're looking basically after 15 European countries. Welcome to the conference, and over to you with the question, what does the asset management industry need to scale up that sustainable investment?
Thanks for having me. Well, we've come together because we all understand well that within climate, humanity, and in fact the economy, we have reached an absolutely critical point. The environmental challenges that we face are quite massive, and we need to address them today as part of this conference so that all stakeholders, businesses, governments, institutions, and citizens understand and acknowledge these. There's an economic reason as well. Increasing data evidence suggests that sustainable companies simply outperform and provide higher long-term returns compared to those that are not. Hence, the asset management industry, our industry, has the responsibility as stewards of client assets to engage. I passionately believe that as a leading international asset manager, we play a key role for investing in sustainable companies. Our work can contribute significantly to this transformation towards a healthy planet, and a much more sustainable and resilient economy. To put things into perspective, the transition to a low-carbon, zero-emissions European economy will require additional investments of roughly 180 billion euros annually, as was calculated by the Sustainable Finance Group that was just mentioned by Martin a minute ago. And further funds will actually be needed to achieve climate neutrality by 2050. These are big, big numbers. And a large proportion of these funds will have to come from private capital, as government balance sheets are simply too stressed at this time. So what are the necessary conditions for us to invest in sustainable companies as an industry? Let me take a step back quickly and ask the question, why should we invest in companies that, for example, develop climate-friendly technologies? Well, there certainly is the moral component. The Fridays for Future movement has clearly put on the very top of the agenda, of society's agenda, climate protection. But in today's world, the question could be asked, can we still drive a fossil fuel power car, or can we still fly and take a plane to go on vacation? Well, the answer to that question is a yes, but. As investors, we need to engage with all companies, because the environmental awareness of consumers and their behavior will ultimately have a very direct impact on the reputation of the company, but also the future economic success of this respective enterprise. And as trustees to our clients' wealth, it is our role to protect and enhance client assets. And our mission is directly linked to the long-term viability of the companies that we invest in. So companies will need to demonstrate, and we just heard about the additional framework that is coming down the line from a regulatory perspective, they will need to demonstrate that they're absolutely fundamentally modifying their business models towards sustainability. The key word here is engagement, not divestment. To give you an example, the abrupt and immediate divestment of all fossil fuel-related companies would trigger an economic collapse, because the share of energy consumption originated from fossil fuels is still well over 2/3 of the total energy consumption globally. You can't just turn it off. However, it is feasible to build pressure on companies through frequent meetings, through agreements, milestones, and also by following up with them regularly. Of course, divestment remains a legitimate tool, but it's a last resort. And hence, I'm in favor of a realistic and honest discourse that supports the transformation ultimately to a carbon neutral economy. As asset managers, we ourselves need to be pioneers as well. Fidelity International has committed to carbon neutrality for our company by 2040 latest. Now, the moral dimension is important in the ESG discussion. However, economic aspects are equally important. ESG is not new. What is new, however, is that the correlation between ESG factors and financial performance has become much better measurable as a result of the increase of data and transparency. And there's more to come, as we just heard. At Fidelity, we use our own proprietary ESG rating approach. And in a recent study, we could evidence that during the first 9 months of this year, during the crisis, corporates with high ESG ratings significantly outperformed companies with lower ESG ratings. As a trustee, investing in sustainable companies has become mainstream, and it's no longer a voluntary exercise. But the question is how to get there to invest. As the title of this session says, what is necessary for asset managers to invest in sustainable companies? I'm proposing 3 points for a brief discussion. The first one, meaningful data. The second one, a steady increase in customer demand. We are a business. And third, a reliable regulatory framework. Let me touch on each of those briefly. As financial institutions, we need to have a better understanding of the risks involved when we invest, because there's dependencies between the sustainable factors E, S, and G. In 2017, just as an example, weather-related disasters cost economic cost of over 280 billion euros. And at that time, more than 5% of the European population was directly affected by weather-related disasters. Now, it is estimated that by the end of the century, it will be 65% of the population that will be affected by such natural disasters. So companies must highlight such risk under the guideline disclosures of environmental and social information. The challenge for asset managers is to integrate ESG criteria throughout the investment process. At Fidelity, our 320 analysts and portfolio managers have all transformed into ESG experts. A standalone ESG team, in our view, rarely has the momentum and the power to implement ESG assessments across portfolios and across the firm. Our proprietary ESG tool rates more than 4,000 issuers globally, very specifically on a framework of 99 different factors to come up with an ESG rating. The second point, clients. So the second aspect for asset managers to successfully integrate ESG factors is by translating client preferences into funds, products, and strategies. Asset owners, both private clients and institutions, are crucial to the success of the EU's long-term sustainability strategy, as we just heard. Their preferences determine whether or not capital is channeled into the economy and to the extent to which this actually happens. The ESG trend is client-driven, and the figures, Judith mentioned some of those in the introduction, are quite encouraging. In the last 10 years, assets under management in ESG-related funds have increased by almost 400%. According to PwC, the potential for this market is huge. By 2050, it is estimated to be more than $7 trillion globally. This is also thanks to the regulatory frameworks that are being amended so that ESG criteria need to be considered as part of product design, portfolio construction, and also the distribution process. And this goes along with the obligation, which we already have, for advisors to ask investors on their individual sustainability preferences when they invest. These initiatives act as a benchmark for the EU Action Plan to promote sustainable growth, and we clearly expect demand to increase quite substantially from here. As a third key factor for success, the regulatory framework is an important pillar for several reasons. The taxonomy, alongside the adoption of new EU and global ESG frameworks, provides greater clarity to investors, companies, and consumers on a common approach to what exactly constitutes sustainable finance. They therefore represent a crucial orientation guide to all international finance stakeholders. Now, there's three factors that are important here in terms of regulation from our perspective. The first one is timing. I say pace over perfection. It may take some time for regulation to come into place, experience shows, especially to achieve coherence at an international level, which is the ambition that Martin just talked to. Nevertheless, it is important that industry and policymakers progress with implementing the system as far and as soon as they can, instead of waiting for an optimal global framework to be completed at some point. This will bring about the change much quicker. The development of a taxonomy is an iterative process. We must understand it's iterative, and it will become perfect over time. Second, engagement over exclusion. The taxonomy aims to identify the precise nature of sustainable economic activities. In reality, the lines are not always clear-cut. There is a blurring. Hence, it is welcome that the taxonomy captures transition and enabling activities. This allows investors to remain invested in corporates that are not yet fully sustainable, but strive to become sustainable in the foreseeable future, and with a clear roadmap to that goal. Asset managers, through our investment process and the engagement skills, can therefore incentivize companies to develop a much more sustainable framework and business activities. The third one, another critical factor in the transformation, is that we need indeed international and global standards beyond the EU. The global climate obviously doesn't recognize borders, and this should not be a constraint for us when we implement regulation. As we welcome the EU's effort on international coordination and encourage the wider community to participate in this ongoing effort, what we have to avoid above all are national solo efforts, diverging local interpretations of EU regulations in particular. A global approach is critical to achieving a meaningful impact. The EU launched an important international platform, we just heard, on sustainable finance, which already includes some of the largest countries worldwide. In parallel, the G20 OECD are working with asset managers on a sustainable infrastructure concept, which actually a first report was presented to the G20 finance ministers just in the last July as an update. Now, what now needs to happen if we look forward is that during the G20's presidency of Italy next year, that we build on this effort and promote its practical implementations in coordination with the European Green Deal. International finance, however, encompasses both private and public investments. And again, Martin just alluded to that. It is therefore crucial that public actors also apply the same standards as privates and vice versa when investing in companies. Especially now, where there's a lot of industries and companies that will benefit from large COVID-related recovery packages. If we don't do that, there's a real risk of creating an uneven ESG playfield between private and public sectors. And that could result ultimately in a much weaker and less resilient economy. If the EU manages to act quickly now, Europe, we believe, can become the blueprint for a transformation to a new sustainable economic order. And this could be a way to re-establish Europe. That's the opportunity, re-establish Europe as the continent of innovation. The management consultancy Capgemini has carried out an analysis which showed that the EU Reconstruction Fund alone could generate gross value add of close to 800 billion euros by 2030 if the money is channeled in the right fashion into the right sustainable projects. The philosophical consensus among governments, regulators, investors, but also citizens to achieve this objective is greater in Europe than anywhere else on the planet. This is a huge opportunity for Europe. It's also a sizable opportunity for Luxembourg to become a leading sustainable investment fund center and administration hub. The green bond issuer, the European Investment Bank, just located across the street from here, is a good example of a leading provider of green bonds listed on the Lux Green Exchange. Now, I would like to conclude with my remarks with the fact that sustainable companies will act in line with environmental as well as social government standards, are performing and will perform better. Hence, they will be and continue to be the investment of choice for our clients at Fidelity. With this, I invite you all to work together across the policymakers, across regulators, across the financial industry, to build a better and more sustainable financial future for our generation and, more importantly, for generations to come. Thank you.
Thank you so very much. Virtual applause for you. Thank you, Christian, for your inspiring and, again, thoughts and the rallying call to collaborate on so many levels, which seems to be built into the DNA of sustainable finance and sustainability. So thank you. And we will build on these thoughts now with our panel of experts, and we will drill very much down into the question, what does the investment environment look like in regards to sustainability? So taking the pulse there, and then answer the question, of course, does the European Commission's taxonomy make indeed financial markets more sustainable? So here we are with our next panel of this conference. And before I introduce everyone to you, a quick reminder to everyone online that we have 2 digital tools that you can use to join us in the conversation. A Q&A tool, which is just below the streaming window if you scroll down a bit, and also a polling Slido tool, which will activate in a second and ask you a question that will feed then into our conversation. So we have from across Europe 4 participants and experts in their field. So we have a bit of a cluster from the UK, which is why I start with our participant from the Netherlands. A warm welcome to Hilde Velert, Head of Equities at the Dutch asset manager Actiam. Hilde, welcome to you. And then moving across to the United Kingdom, I have the pleasure to welcome Ingrid Holmes, Director and Head of Policy and Advisory at Federated Hermes International. I should add that she's also the firm's climate change coordinator. And then we have Ian Richards from Columbia Threadneedle Investments, EMEA. He's responsible for responsible investment, and I remember him well from last year's conference. It was the analog version here in Luxembourg. And then we have the odd one out, if I may, Dana Kyriakopoulou, Chief Economist and Director of Research at the Official Monetary and Financial Institutions Forum. For those of you who don't know OMFIF, it's a think tank for central bank policies and, if you will, sovereign and public investors. So welcome to all of you. Thank you for making time for the conference. And I want to quickly throw the polling question at our audience out there so you can get in your votes. And the polling question is as follows. When do you think capital markets will be fully green and sustainable? And we're giving you 5 options there. If you just look below the screen, below the stream window, you should see the choices there. So the first option is up to 2 years. Here we have them. Up to 3 years, up to 5 years, and up to 10 years. And then for those of you who are very patient, up to more than 10 years. And I can see we already have a run-up. We leave it there for a second so everyone can get their vote in. And I now want to do a first round robin, dear panelists, with you with the question, building on what we just heard from Christian Stalpe, in what way is sustainability playing a role for your investment, for the investment decisions of your clients, and that I suppose many of them will be across Europe? Can you give us a flavor of what you've been observing, especially over the course of this year, but maybe also in a bigger context? And I want to start with you there, Hilde, if you may, please.
Hello. Yeah, we see in the Netherlands, we see indeed a growing demand for sustainable products. It's becoming more and more mainstream here in the Netherlands. Within this growing demand, we also see a shift from the more traditional ethical overlays, like we had them already since many years, to more darker green products. So we see more room for exclusions or more attention for material ESG risks. And we see also more demand for impact strategies. So investors more and more see the long-term financial potential also from these impact strategies. Further, we also see some difference between institutional demand and retail investors. A retail investor typically has a more thematic interest. He looks for topics which are closer to him as an individual, for example, fossil fuel-free funds or animal welfare topics. While from the institutional side, we see more that they act from their fiduciary duty, so they look more for financial materiality. They put more targets, they bring ESG beliefs into their general investment beliefs. So that's the difference we see between retail and institutional. For an investment process, I have to say at Actian, we don't differ between these two kinds of demands because we always integrate the financial and ESG characteristics of companies.
Thank you so much, Hilde. And if I may move across to Ian. Ian, what are you observing there? I recall you gave us some insights in how things are evolving over at Columbia Threadneedle, but maybe something has changed since last year as well.
Yeah, I think we're seeing an enormous acceleration of client interest. I think it would be fair to say that the impending EU regulatory reforms have people running around trying to work out what it means for them. But underneath that, in terms of allocation of capital, we're already seeing the increase and the acceleration. And so I think that the introductory speech referenced forecast inflows and growth in RI assets, and the PwC number is not just above 7, it's above 7.5 trillion. It's enormous. So the acceleration, partly driven by regulation, but equally people being able to make more informed choices through intermediaries is having a significant effect. So where there's been disintermediation before, the market is starting to connect up and people are beginning to get optionality and choice that perhaps they didn't have before.
Excellent. And moving across to you, Ingrid, what are you observing with your clients, and as you have that advantage as a long distance runner, because you've been looking at the issue of climate change for your company for such a long time, so you have quite a long range perspective there.
So I'd say in the last sort of 3 years, we've seen a massive uptick in requests for information in RFPs around how we're looking at climate change, looking at sustainability. We had those previously, but I would say that's due to the policy effect of the high-level expert group and the greater dialogue on the importance of these issues. So we've just seen that really accelerating in the last few years. And this year, as soon as the sustainability-related financial disclosure regulation and taxonomy came out, we have prospects explicitly asking us about how and whether we'd be reporting against those regimes. And of course we will. I'd say a lot of the focus has been European investors, but not exclusively. We have clients from across the globe. And I think just the heightened awareness of this issue has seen a driving of interest across all jurisdictions. So it's a very exciting time to be in the business and looking at these issues.
Very much so. And Dana, over to you. You're keeping an eye on more those public investors and sovereign investors.
Yes, thanks, Judith. It's a pleasure to be here with you all today. As you said in your introduction, our members are central banks who manage reserves, of course, as well as sovereign funds and public pension funds, institutions that manage public money. And we have seen that strong demand over time. But what we've really seen this year, and we document their preferences in terms of how they're integrating sustainable investment, is that in the beginning, when these investors start their journey, they start with kind of the easy steps, if you like, where it's some exclusions of some sectors and also perhaps tipping their toes in green bond investments or some sustainable asset classes. What we're seeing now is that for investors of that big scale, a lot of them have over 200 billion under management, a lot of the very big sovereign funds, even approaching trillion of US dollars under management. They cannot do that at scale. You cannot exclude that many sectors. There's also not that much of a supply of sustainable asset classes. So they're moving into more sophisticated approaches in terms of how they're integrating ESG, both in terms of active shareholder management, which is a more complex way to engage with sustainability targets. But also the other trend that we're seeing is in terms of the measurement, and we are going to be talking on this panel a lot about the taxonomy, but the big barrier that they're seeing in terms of how they're integrating ESG is how to measure things. And a lot of them are building their own ratings. We published a report in September together with Refinitiv looking at the data issues and how they can not just rely on corporate disclosures for the institutions they invest in, but also take advantage of geospatial data, for example, or new technologies and data analytics, understand their own impact, not just the impact on their portfolios, but also the impact of their portfolios on ESG factors. So these are some of the trends we're seeing with the sovereign funds and pension funds. And with the central banks, of course, on the regulation side, they're doing a lot of things there in terms of climate risk supervision and regulation. We can talk about that more in the panel, but that's an overview to start with.
Thank you so much, Dana. I want to get a better feeling of what is changing really in the investment process, because Christian already made the point earlier how important it is to get good quality data. Companies need to catch up with their reporting and so forth. Ian, if I may throw that back to you, can you give us a bit more insight into the nitty-gritty details of that sustainability integration, ESG data integration, finding the good quality numbers Christian was referring to?
Yeah, so I think you could probably use two examples to explain and frame this. I mean, if you look at the bond markets, you look at what's developing around the issuance of green sustainability and social bonds, you see an enormous allocation of capital towards solutions. You see a real willingness from the capital markets to support those, whether it's in COVID responses, for social purposes, for green purposes. That type of dynamic is becoming much more integral to fixed income investment. On the equity side, I think that there's still a fair degree of thinking going on from the clients about how far they want to push this and what they want to achieve at one end of the spectrum, funding the policy agenda through the taxonomy versus potentially matching the liabilities on their balance sheets, and the challenges through that. People, even those who are quite advanced in their commitments to climate change, are still walking slowly and taking small steps in trying to unravel the complexity that's being created by the regulatory reforms. So it's a mixed picture, and people are engaged, but their commitment to approaches is still evolving.
Okay, thank you, Ian. Hilde, would you like to follow up there and give us a flavor of that more detailed changes in the investment process on the equity side?
So at Actiam, we already have a long history in sustainable investing. So in our investment process, we already use a lot of data to do screenings and to have first ideas about how sustainable a company is, and we use a diversified set of data. But then referring to the EU taxonomy, yeah, that will also for us be a challenge because the data are not available, and with the current data we have now, we can do the disclosure obligations, but on the entity level. But if we have to go deeper, then we will need extra data to do that. And that's a big challenge for the coming years.
So there's still some more work to be done, quite clearly. So allow me to now throw in the result of our polling question. So just to remind our audience and our participants, so when do you think capital markets will be fully green and sustainable? Okay, so we're looking at the long-term perspective here. Definitely 55% are saying it will take more than 10 years. Runner-up is 5 to 10 years with 42%. And not so much optimism for the short-term perspective. Can I ask around Robin in our panel, where are you coming in with? Maybe Dana, let's start with you. Would you agree with the top choice?
Yeah, I would say kind of around 10 years is a reasonable horizon. It's also the time that we have. The window of opportunity is short, so I think we should be ambitious in terms of achieving this within the next 10 years. Capital markets have a very important role to play, both in the adaptation and mitigation of the climate emergency. I think there is a lot of work to be done in terms of the data, but regulators, central banks that we work with are also realizing that we shouldn't make the perfect the enemy of the good. So even though we don't have enough data, that doesn't mean we should wait to implement policies, to set regulations related to this. So I think we can be more ambitious.
Yeah, it sort of chimes what you're saying there with what Christian earlier said, with pace over perfection. Ingrid, I saw you nodding there. Do you want to give us your flavor? So again, 55% of our online audience thinks, well, it'll take more than 10 years. Would you agree with that? Or are you more optimistic? We can get there quicker.
I want to be optimistic and I hope we will get there quicker. But the reality is we're facing an economy that is vastly unsustainable. And we do have these challenges around the transition. The taxonomy will help define what a good future looks like. But the reality is when we get there will depend on capital expenditure decisions by companies, how they realign business models, generate new green revenues. I think we've got a really important role to play as investors in engaging with those companies to accelerate that transition. In some cases, there will be viable new business models. In other cases, we're talking about a managed decline. And that's really the dichotomy we face here as asset managers. Our clients face it. How do we balance the needs of the environment and society with the needs to generate financial returns to service liabilities? But I think the other sort of piece we need to be thinking about as asset managers is actually advocacy with governments to say, put the frameworks in place, take away those barriers to transition and help us all get there a bit quicker, because we know, as Dana said, we are running out of time. We are in a climate emergency. So I think just my final point is, this is why I would underscore the importance in the next phase of the Sustainable Finance Action Plan of seeing asset managers play a significant role in stewardship in undertaking this engagement that's needed to accelerate that process. With that, we will see an accelerated greening of markets.
And then to our other two panelists, let me throw it over to you, Ian. Again, would you agree more with a long-term perspective, or are you a bit more optimistic?
I think if we talk about the market as a whole, I agree with the long-term perspective. I think we will see pockets of excellence develop underneath that. So there will be a transition, but I think that the reality is the longer-term horizon. I think that, and I will condition that on the basis that the framework supports meaningful investment in that way, rather than a blanket approach that misses intentionality. Because I think that there is a question mark about the framework not targeting where the funding gaps are and taking just a broad one-size-fits-all approach that won't necessarily move the agenda forward in the right way.
I'm making a note of those pockets of excellence. I may come back later on. I'm curious what you think there might be. But last question, or last one to answer or reflect on the polling result, Hilde. So we have more than 55% thinking, okay, it'll take more than 10 years to really green the capital markets. Or are you a bit more optimistic?
I also hope that it will be sooner, but yeah, I don't think it will happen on a short term, because indeed there are still a lot of hurdles to take. And again, this data is really a problem. So it would help if there would come like a central database where we can, investment companies can take this data out. Another thought is, of course, sustainability is more than only green. So the current taxonomy is focusing on climate. I think really to become sustainable, also other criteria, social criteria have to be added, like decent work or quality education. And then I think the regulation currently is about disclosure and transparency, but that on itself, of course, does not bring change. We can expect that by being more transparent that investors and companies will change, but of course, it's still up to these investors and companies to really change and decide on how sustainable they want to be in the future.
Okay, I just want to add that one of the 6 areas where the European Commission and indeed the Sustainable Finance Department knows it needs to do some more work, Martin Spolz spoke about that earlier, is expanding, being more comprehensive beyond climate and including the taxonomy, or expanding the taxonomy to include a broader environmental issues and also social objectives. So that is in line with what you were saying there, Hilde. So we've already touched upon the EU taxonomy in some answers, but let's bring it round a bit more specifically. In how far can the EU taxonomy really support sustainable finance? Ian just raised some criticism there that it's not quite addressing where the funding gaps are. Maybe you want to follow up there a little bit, Ian, and broaden it out a bit.
Yeah, so you can either look at it from a holistic view. So if you take the European market, the majority of companies are involved in investing in climate mitigation activities. If you then start drilling down into how that aligns and the extent that it's appropriate to align that with the EU taxonomy, you'll start out by looking at what are taxonomy relevant revenues. And so let's use the DAX as the example. You're looking at about 27% of revenues are taxonomy relevant. If you then put the taxonomy criteria that are extremely detailed in place, only about 19% of those. So you're now left just at the second stage of the taxonomy with only 5% of revenues in the DAX. If you then start applying the other criteria, do no significant harm, you're down to 1% of revenues, and then you go on and you have other criteria and other conflicting provisions within the regulatory framework. So in Germany, the automotive industry, I've seen the case made, let's be generous, 69% of revenues are taxonomy relevant. If you apply the full taxonomy, that's down to 1%. If you apply the full EU regulations, none of it counts. I've seen a lot of case studies that haven't been rigorous in applying all the standards. And I think that there is a concern that by trying to be micromanagement perfect, we self-defeat the need to fund transition, create change. Just one small example is R&D investment towards climate transition, energy efficiency, new technology is excluded from the taxonomy. So that there are lots of little components that, as we go through, hopefully will get addressed and become more practical. But I think there is a danger that it becomes a bit of a disclosure sideshow because it is too narrow as it currently applies. Either that, or we'll see boilerplate and greenwashing to work around the restrictions. And that would be an enormous shame, a massive own goal, and defeat something that is critically important to everyone, whether it's the clients, the investment managers, society as a whole, or the policymakers. And I think it was a huge relief that the level 2 regulatory technical standards were withdrawn for further work, because if we'd pushed ahead, the unintended consequences would have been a real shame. So
quite a few caveats there and pointing out of dichotomies or counterproductive developments there. Thank you. Who else wants to respond to that or follow up on that? Dana, may I throw it over to you and then maybe Ingrid? Dana first.
Yes, thanks. Thanks, Judith. No, I think these caveats are all very valid. I think we shouldn't ignore, though, the fact that it is an important step in the right direction, that a lot of jurisdictions around the world are looking at the EU for leadership on this. I think it's an area where, because for various reasons, we haven't seen as much activity in other parts of leading capital markets regions in the world. The EU has a chance to kind of forge those standards. And it's certainly welcomed by a lot of the members of UNFIF in terms of having that process happening. It doesn't mean that as long as we do anything, that's fine. There should be more detail. I think the dichotomy between green and brown is too simplistic. We need to move beyond that to understand what it is that is the transition, because you can have quicker wins there by focusing on that. I think also the fact that the thresholds and how these are defined can be open to lobbying is also a concern. But I think overall it is a step in the right direction. It's certainly work in progress. We should be pushing for all these things that Ian and others have described in terms of making it more targeted and also more specific. I think there is the risk of greenwashing. I would agree with that in terms of turning it into a box ticking exercise for disclosures as well. But I think we are seeing the results already, that Europe is seen as a region that is ahead in this. We're seeing it in terms of the capital markets activity. Around half of green bonds are issued in euro. It's not an international currency in other respects compared to the dollar, pound, etc. So it is a big chance for the euro, for Europe to be ahead in this. And the process of having the technical expert group that could also be improved, bringing more scientists there to understand the threshold in a different way. So I think there's a lot of things that we can discuss in terms of how it can become more effective. But I wouldn't be as pessimistic in terms of it's an unwelcome development.
But what you're saying there, that chimes with what Christian said earlier. Definitely an opportunity for Europe to step into a leadership role, and then for maybe other denominations pick up what is being thought out here. Let's move across to Ingrid, maybe also following up on some of the caveats Ian has just been raising.
Yeah, so I mean, I should disclose I was actually a member of the high-level expert on sustainable finance, the originator of this regime. And the reason the taxonomy arose as an idea was as we reached out to market participants at that time, so this is quite a few years ago, many of them were saying to us, we do realise we need to act on climate change and sustainability, but we don't know how to define it. So the taxonomy was simply providing a solution to that question. And it really stepped into a breach left by governments who'd set long-term climate and sustainability goals, but no near-term targets, which then leaves lots of questions around, well, what exactly should be the market be helping to drive? So I think we will see a period of adjustment as this taxonomy comes in. It is a completely new economic activity-based way of thinking about the issues. And it will also present some issues for frontrunners, such as ourselves, and I suspect many others. In the absence of clear definitions of sustainability, we came up with our own. So we have our own sustainable taxonomy, and we will now need to overlay this EU taxonomy on top. It's the fate of the frontrunner to have these things happen to you. It's the nature of progress. So I think that's why we'll see pushback. But I think at the end of the day, we have to ask ourselves, who do we want defining our sustainable future? It will need to be, at least in the context of climate and environment, science-based. And I think that what the taxonomy is doing here is taking that science-based approach and laying out what our good future looks for us. So in the end, I think it will be preferable to a market-based approach, but it will cause some consternation in the short term. Just a final point, I do agree we do have some issues around the definitions in the sustainability-related financial disclosure regulation. We had hoped and expected that the taxonomy would be built into that new reporting regime for financial institutions, but we've ended up with two parallel approaches which don't really make much sense. So that is something that in the short term does need to be fixed, as Ian mentioned.
Thank you. Then moving over to you, Hilde, to also add your voice to some of the concerns, and then maybe on the other side, the agreement that it's a work in progress, and we're all pulling together both on the side of the industry and the regulators.
Yeah, I think the taxonomy, it's a great initiative, and it's also great that Europe is here in the leading position. I think the taxonomy is done very methodical. It's very scientific based. I think we want to do it like for 100% perfect, but that will make it also very complex. So from the investment manager companies, it will also be very complex to report in line with that taxonomy. And maybe that's then the risk for our approach. If it becomes too complex, then maybe then maybe it won't be the preferred solution for investment managers.
Okay, let me follow that up with one word that was just raised earlier or several times, which is, of course, greenwashing or social washing, because we have now also an expansion of the social aspect of sustainable finance with various bonds being issued to mitigate the impact on livelihoods. For example, the EU social bonds as well, which created basically bond market history with that enormous response in the market. So can some of you give us an idea how you working or what you're seeing is working in the market to mitigate that? Efforts to do greenwashing or social washing, or basically sell under the umbrella of ESG, but actually underneath it's the same old product or service that is being sold. Maybe over to you, Ian, what you have in place there over at Columbia Threadneedle.
Yeah, so I think it's really important that you have a framework that's clear about the nature in which and the nature of the approach in which ESG data or sustainability data or social analysis is being used. And I think this is obviously one of the key things. The term gets used generally and everyone assumes they mean the same thing, and they don't. And I think that need for greater clarity about the way data is being used, to what purpose, and the variations within it. And this is the challenge potentially that's being created by the EU regulations. You're either Article 8 or Article 9, end of story. And there's all sorts of variations around that, around pursuing best in class for quality to support your ability to match liabilities. That doesn't quite fit within that model, but is an absolutely essential part of solvency requirements for insurance companies, for example. So I think that there is a challenge here. We need more transparency. We need better understanding. The difficulty with having a very rigid, narrow approach is that people hide behind that, and that's where it drives through. So another example of a driver within the framework, the taxonomy has global application. The NFRD that we've all been talking about, we're going to have better corporate disclosure, is only Europe. So if you're running a global strategy, whether it's a fixed income or equity, emerging markets, Asia, sovereign even, where does that leave you? You have all these obligations. So that's one element of it. I think another element is the framework hiding what is actually going on underneath. And this is something we see in particular in the green bond market. And so just pointing towards some of the EU frameworks fixating on we need to deal with scope 3. And what you lose in doing that is sight about progress that's really being made. So if you look at the impact of green bonds on carbon emissions, including scope 1, 2, and 3, you don't see an impact. And what you're hiding is the impact that's taking place at the issuing entity level in terms of scope 1 and 2. And so there is that danger that over-regulation has unintended consequences and people migrate away to supplementary disclosures, and you end up going back into the situation we had in the past when no one was quite sure what things meant. So these are all things that can be solved going forwards, but we do need to be mindful about them and mindful of the risks. And I think there are other aspects that are equally important to that, but we need to be honest about how we take this forward so that it is effective, because it has great potential if we get it right.
Excellent. I would just want to ask here and the team in the studio, if we have any Q&A coming in, feel free to throw them my way. I'm seeing thumbs up there. So Robert, are you ready to give us a question that might match the current conversation?
Yes, absolutely. Perhaps to Ingrid first. I've got a question here regarding the EU taxonomy. Does the EU taxonomy push institutional investors outside of the EU to invest more sustainably? So does the EU taxonomy have an extraterritorial impact, a bit like GDPR did?
I think that remains to be seen, because it will depend upon whether companies in extra-European jurisdictions actually adapt this as a reporting framework. We have looked at this as an asset manager investing globally. So within, for example, our SMID suite of products, which are primarily US focused, we had a question from a client around whether we could be reporting against that taxonomy. The response was, we will do our best. Where information is available, we will seek to report it. And where it's not, because we actually, as an active investor, have dialogue with those investee companies, we will seek it from those companies. But as I mentioned earlier, it is an entirely new way of thinking about how you report your CapEx and revenue, so it will take time to flow through. That said, I think the EU has had enormous influence in this global sustainable finance debate and will continue to do so. So I would expect this type of approach to be replicated in other global markets. After all, we saw the huge amount of work that went into just creating the first tranche of the taxonomy. Why anybody will want to replicate that process, I don't understand. So I would hope to see it adopted as a global standard.
That would also have been my next question, actually, in my line of ideas there. And I want to quickly throw it over to Dana, because, of course, also you have very much that international perspective there. Is what is being thought up in Europe in terms of sustainable finance ecosystem, is that already arising as a forerunner of a more global idea or standard? Dana?
Yeah, we certainly hear that from regulators from around the world, that they are looking to Europe as the example. Of course, there's other initiatives happening. For example, China has its own taxonomy. Malaysia and others are developing their own as well. So there's parallel initiatives going on elsewhere, Mexico. And I think it links also to the previous discussion we had about greenwashing and what Ian was saying about how do you bring everyone on board, because you have different market structures in different economies. For example, in China, you have a lot more state-owned enterprises. So how can you impose a similar structure and system in terms of disclosure to different jurisdictions? Also, how do you bring everyone on board, not just in terms of different countries, emerging markets, that may not have the resources to comply with the same disclosure requirements as others? Also, how do you bring on board SMEs that may not necessarily be on the radar of big institutional investors that may put that pressure on? And I think that creates the risk of greenwashing as well, that on the one hand, you want to expand it and be inclusive and have SMEs, have EMs as part of that. But on the other hand, how do you bring everyone on board without that risk of greenwashing? And I think one positive thing perhaps to say about greenwashing, because of course it's something negative, but I think it also shows that a lot of organizations are realizing that they cannot even afford to even show that they don't care about this. And that's a positive thing, that it's become so important that they would go to the extent of greenwashing to show that they care about it. But I think also the other way that we may get around it is that a lot more investors, at least in our network, are realizing that it's not about presenting organizational values, it's not about reputational risk, it's about actual risk to the portfolio because of assets becoming stranded, for example, because of the changes that we will see that in terms of physical risks to real estate and infrastructure assets. So it's a risk lens, which means that once you realize that, there is no point in greenwashing, because you have to do it the right way, because it's about protecting your portfolio from this risk. So that's what I would say, and that applies to EMs, to SMEs, to everyone.
That goes very much back to the economic impact of what we are facing, as Christian was raising earlier. Do we have another question from the audience, Robert, please? Thank you.
Yes, we do. We've got an anonymous question on the impact on the retail investment side. The question is, can the EU taxonomy help me identify sustainable products to invest in? I see little change in the products available on my online broker. I would like to invest sustainably.
Oh, so for the retail investor, Hilda, may I throw that over to you?
Yeah. Okay. Yeah, I think it's like a follow-up action on the EU taxonomy to create some eco-labeling for funds. Maybe that's already in the planning, but I think that is needed to make it clear for retail investors. And then in the meantime, if you select funds or if you select a provider, even now you can look for or ask for more transparency. So some investment managers are already very transparent and do reportings on ESG objectives or impact objectives, and that helps you already to diversify between greenwashing and not greenwashing.
Ingrid, maybe some thoughts for you there. Do you have some experiences how to make things more transparent for those retail investors?
So again, this was something that came up in the high-level expert group. We were looking at some of the sustainable finance products you can get off platforms, and I think there was one SRI one that had Exxon, Facebook, and Apple in the top 10 holdings. So I do think the eco label, when it comes in, will help. And that was the purpose. It was to generate consumer protections around sustainable investment opportunities. But I think there probably is a bit more self-education needed on the retail investor side. There are so many different ways of building a sustainable portfolio. Do you want to be investing in companies that are in transition, that your asset manager is engaging with, or things that are green now? We need better disclosures, but equally on the retail investor side, a better understanding of the different approaches too.
Thank you so much, Ingrid. I think, Ian, was that a hand raising? Were you going to? Yes, go ahead.
Yeah. So I think that there's a component of the EU framework that ties both those two questions together, and it's the suitability requirements. So the obligation for the intermediaries, the financial advisors in the retail market, the platforms, to have to take account of the customers or the consumers' sustainability preferences, and to not offer products that don't align with those. I think equally you see that having an impact in terms of extraterritoriality, people coming into the market, into this framework. I think supplementary national rules like the proposed AMF regulations in France will have quite a significant impact in creating clarity and setting standards that will support and facilitate choice amongst the retail investors. And there's clearly demand for that, absolutely.
So thank you for clarifying that. So to that person out there who's been asking that question, again, it's a work in progress, but the problem is known and the industry is working on it. Just checking back with Robert, there's another question that we have for the panel. Thank you.
Yes, to the asset managers of the panel, and this is perhaps...
The asset manager of the panel? So,
yes, this is perhaps from a nosy competitor. It's a simple question, but difficult to answer. How much % of your assets are currently invested sustainably, and how much will that be in 5 and 10 years?
So what's the share? Ingrid, you're nodding there. You want to go ahead first?
I haven't got the numbers at my fingertips, but I can tell you about general trends. So we at Federated Hermes have got a long track record in integrating ESG into our investment processes, and actually had a really interesting discussion with a leading European regulator on how we meet their new requirements. And the answer is we don't, and it's fair enough. So we know we integrate ESG factors. We've got plenty of evidence to show that this has a demonstrable effect on how we manage our portfolios, but we need to prove it. And that's why we are now seeing a growth in our impact and sustainability labeled products, where we explicitly focus on recording measurable difference and impact that we've had as a result of putting that portfolio together. And this is just, as we've already discussed on the panel, a reflection on this market growing up. So I can't tell you the exact numbers, but I can tell you that's the trend, and we expect more client demand on this properly documented impact and sustainability fund space.
So awareness to do homework there. Hilde, over at Actiam, What is maybe, give us a feeling of the balance between sustainable and non-sustainable there?
For me, it's a very easy question because
Okay.
at Actiam, 100% is sustainable invested. So
100 points for you.
Yeah, and we are also very transparent on it. So we have an ESG dashboard in which we are very transparent on the ESG objectives and impact objectives of the different investment styles or strategies.
Excellent. Ian, over to you. Netherlands is winning here.
I think it will depend on the region from which the clients come and how you want to define sustainable. Because every EEA domiciled fund, whether it's a retailed fund, a segregated institutional mandate, will have to integrate the Article 3 and Article 4 provisions on sustainability, risk and adverse impact. There are some structural opt-outs that some people may choose to go. So in theory, you could argue everything in Europe. It'll be slower in the US. Obviously, that will depend on the US election. In Asia, again, it's developing at a slow pace from a ground point. If we take, I would love to sort of say, PwC is predicting 450% growth in responsible investment assets. I'd love to sort of say, there you go, that's my target. But I think it will depend enormously by region. I think that the biggest growth, because it will be mandated, will be in Europe. And I think my expectation is that the way PwC is forecasting it is including the Article 3 and Article 4 as opposed to the Article 8 and Article 9 frameworks within the EU regulations. So clearly growth, but it's not going to be uniform.
Okay, Dana, maybe a final word. Where do you think the balance is with those large sovereign investors and public investors as far as the balance between sustainability-focused investments is concerned, if you have access to any data?
So we did a survey actually together with Bank of New York Mellon, another custodian, where we surveyed pension funds and sovereign funds in terms of the way they integrate ESG, and there were some forward-looking questions. The trend is certainly in terms of more sustainable investments, but the barriers to doing so is supply, and I think that's the kind of development of sustainable capital markets, social bonds, as you mentioned, because these are big investors. They cannot go after the small private equity deals. They cannot go after directly investing in real estate and infrastructure to a big scale. So green bonds, social bonds are good instruments for them that are looking for liquidity. And I know we had discussions also about kind of how there can be a fragmentation as you see more thematic bonds being issued. And the second barrier is also about the data. And a lot of them are creating now their own platforms, tools, internal ratings. And I think that can, if that goes the right way, we can see a really big increase in the scale of sustainable investments. But the trend is going that way, but there are these barriers that mean that they cannot increase their sustainable investments as much as they would like.
Okay, thank you, Dana. So last question now from me, just very briefly, where do you see financial services and sustainable finance 3 years down the road? We've already agreed it'll take probably more than 10 years to truly green the financial system. But just casting your eye out some 3 years, where are we in this integration of sustainability in financial services? Hilde, if I may start with you and then on to Ingrid.
Yeah, I think in 3 years, the whole regulatory framework will have will have more clarity, and it will be, there will have been progression, and maybe some social objectives will have been added. And I hope that by then, because we have to be more transparent, and companies also have to report ESG data, that it will also have triggered or started to trigger the actual change of companies. Because, of course, we need more sustainable companies in order to invest in.
Excellent. Thank you. Over to you, Ingrid, with the same question. 3 years out.
So I think we will continue to see growth in sustainable finance products, but also growing confidence that those products actually do what they say they do. That will be because we see an adjustment of reporting approaches, an improvement of data from investee companies and so on. But I do think, I am heartened that both Martin and Christian, our keynote speakers, talked about the importance of engagement. I think we need to see more engagement by asset managers in the market. It's currently a very northwestern European phenomenon. We need to see that rolled out across Europe. Because I think without it, we risk a bubble in green assets as demand outstrips supply.
Thank you for pointing that out. That has been mentioned yesterday also during the conference. Dana, also to you, the question, 3 years out.
Well, we have an election in an important country coming up very soon, and I think the outcome of that will really be very important in terms of what we see in the next few years. If we see a change in policy direction in very, very big capital markets, that will be very important in terms of seeing companies and financial institutions move in that direction and having the regulatory support to do so. So I think that would be the biggest game changer. In terms of what we're seeing here in Europe, definitely the kind of developments in regulation and also what Hilda was saying about moving beyond just climate and the kind of other seeing sustainability more holistically. I think the pandemic is really sharpening that awareness of the potential of non-financial sources of risk beyond climate change, and kind of seeing that in this way is an important understanding that will shape what we see in the next 3 years.
Excellent. And Ian, you have the final word there.
I think for me, in three to 5 years' time, we have the most amazing opportunity to make this work. But I think we need to be realistic and not just hope for the best. We either get it right or we get it horribly wrong. And if we replicate some of the problems we're seeing in the taxonomy in green bond standards, we may derail the most incredible development that's already taking place, regardless of the EU regulatory reforms, in the capital markets funding solutions, whether it's green solutions, the amazing funding that's been given to help respond to COVID, the allocation of capital to social projects and initiatives. That's happening regardless of these reforms. And I would just caution that some of those developments we mustn't derail by replicating the mistakes we've been making so far. And it's really important that we build this out right. So I think potential for huge success and change, but the potential to trip ourselves up badly if we're not careful.
Thank you so very much to you, Ian, and also to Hilda, Ingrid, and Dana for our terrific expert panel. Virtual round of applause from our online audience. I say goodbye to you all now and do a very quick wrap up, sort of my takeaways from our discussion. The taxonomy very much is a work in progress, but it is definitely a positive evolution of something that had to be thought out basically from scratch. And one very positive aspect is, of course, that it is science-based, and which makes it all the more difficult to be sure that we're not overdoing things and not drilling down too much in minutiae, but allowing the market also to apply it in proper fashion. It is, as the panel agreed, and as we already said also yesterday, an opportunity for Europe to show up as a leader of innovation and set the global standard for climate action in financial services. And as we heard yesterday, Bertrand Badré, our keynote speaker, saying making the financial sector really part of the solution and providing profitable solutions for the problems of the world. And to that effect, to that end, it is of course very, very important that we have close collaboration, as Martin Spolz from the European Commission said earlier, close collaboration between the regulatory side and the practitioner side, and also as a global community, so we don't have individual regulations and standard in various denomination, but can agree around a common standard. As Christian, our keynote speaker earlier, was saying, making that point, this is truly, truly important, having a reliable, clear regulatory framework. This is what asset managers need to invest in sustainable assets. This on top of course, customer demand, because their businesses need to earn money, and then good quality data, good reporting from the company side. So tomorrow, on the final day of the conference, we will tie it all together, and if you will, bring it down to a bit more a practical level and hear from sustainable finance pioneers and practitioners how to finance this transition to a more sustainable future. We'll hear from Ambroise Fayol, the Vice President of the European Investment Bank, which launched its first, and indeed worldwide the first, green bond back in 2007, just before the last financial crisis was starting to unfold, and is indeed to this date the largest multinational issue of green bonds worldwide, with a volume of 32 billion euros. And as the Minister of Finance yesterday pointed out, the leadership of the EIB is vital to crowd in the private sector, because the public sector alone is not enough to summon all the capital needed to reach those emission reduction targets. And the private sector also tomorrow will have its say in a panel discussion which will cover financing the transition in different sectors. For example, we heard a bit of that today, that we need to talk to those sectors where emissions where we have very high emissions, but where a reduction is a challenge. As Christian was saying earlier, it's important to engage and to bring these sectors around these hard to abate sectors, for example, transportation and mining. So we'll talk about all of that. On top of that, given the rising importance of the social impact of sustainable finance as a result of the pandemic and the growing importance of the S, if you will, in ESG, we will bring you the results of a brand new baseline study commissioned by Luxembourg for Finance about how European financial institutions are addressing human rights in their investment activities. Making human rights an integral part of sustainable investment strategies is also top of the agenda for our final keynote speaker tomorrow. Our final highlight of the conference, Fiona Reynolds, will be joining the conference as CEO of the Principles for Responsible Investment, which, by the way, at this point has more than 3,000 signatories worldwide, which is the equivalent of $90 trillion in asset management and accounting. And of course, you may know that the PRI is also instrumental and very much working closely with the EU Commission to keep developing that sustainable finance ecosystem. So, lots to look forward to tomorrow. My thanks from our team here for bearing with us and joining us today. I look forward to seeing you tomorrow at 11 a.m. Central European Time for the third and final day of the 2020 Sustainable Finance Forum. Thank you for joining us today.